Some of the best ETFs to invest in are offered by three of the most popular financial institutions known as Schwab, Vanguard, and Fidelity. And one of the reasons why these ETFs are so popular is because they have a strong track record of consistent performance year over year. So I wanted to go over some of my favorite Schwab, Vanguard, and Fidelity ETFs that I think are some of the best ETFs to invest in, and over time will help you become incredibly wealthy. Now keep in mind that I'm personally a little bit younger of an investor, and with that I am more focused on growth. So these ETFs are more catered towards higher growth rather than dividend income or as a hedge against volatility. The first one is a Schwab ETF called SCHG, and this one is just a high growth machine that typically produces double-digit returns on a yearly basis. And the thing I really like about all these ETFs is how low you pay in expenses every year. So SCHG has an expense ratio of 0.04%, which means you're paying a lot less in fees compared to most other ETFs. And it's the same case for the other ETFs mentioned in this video. Now, the reason why SCHG is such a fast-growing ETF is because it consists of some of the fastest-growing large-cap companies in the United States. In its portfolio, you'll find Apple at number 1, making up about 10.5%. Then we have companies like Nvidia, Microsoft, Amazon, Meta, Tesla, and Broadcom in the top 10. So in the top 10, it really is just the Magnificent 7 stocks, but out of the 230 different holdings, there are a lot of other fast-growing large cap companies that contribute to all that growth. Now, SCHG did just go through a recent split, so its current share price is right around $28.71, which is right at the top of its 52-week high and also its all-time high. Now, these returns are going to seem almost too good to be true, but that is because we have been in a bull market for 2 years in a row now. But if you were to have invested into SCHG 10 years ago, you would have a compound annual growth rate of 16.8% and outperforming the S&P 500 by about 3.4% on a yearly basis. So this is one of the many reasons why I love SCHG, because it really outshines when the market is in a good spot. This brings me to the next one, which is VGT, or the Vanguard Information Technology ETF. So this one is, of course, very similar to SCHG in terms of its holdings. It holds almost the same exact companies in its top 10, but with it being a technology sector ETF, these are only IT and software application stocks in the portfolio. But as we know, technology stocks tend to grow a lot more rapidly compared to other sectors, which is why this ETF is very powerful. It's up 42% this year with a 5-year total return of 186%. It also has a very low expense ratio of 0.10% and pays a very small dividend of 0.58%. So it's less than a 1% dividend, but at least it's still something. Now, this ETF still has yet to split. Its current share price is $645, which is also right at the top of its all-time high. Now, if you were to pair both VGT and SCHG together, there will be quite a bit of an overlap, about 46% between the two funds. But in my opinion, I still don't think there's much wrong with having both of these ETFs in your portfolio for a little bit more exposure to the technology sector. This last one is definitely still one of my favorites, and in my opinion, also very underrated. It's FBCG, or the Fidelity Blue Chip Growth ETF. Now, very similar to SCHG, it holds some of the largest fast-growing companies in the United States, but in terms of weighting, the portfolio is just a little bit different. As you can see, Nvidia is all the way at the top there at just about 15% of the portfolio and has contributed to a lot of the growth this year. And then again, very similar holdings, you have Apple, Amazon, Microsoft, Google, and Meta. Now, when it comes to fees, the expense ratio is much higher than the other two ETFs, but if you look at the growth for the year, it's much higher than the other two, so paying slightly more in fees might be worth the extra gains. It's up 53% this year, currently outperforming the other two ETFs. And of course, this doesn't mean that it will continue to outperform the other two ETFs going forward, but at least we get an idea of what this ETF is capable of. It's a fairly new ETF. It was listed on the market less than 5 years ago, which is why it's still a fairly small fund, but I also think that's the reason why it's so underrated. But let me know what you guys think of these three ETFs and which of the three you're more likely to own shares of, and I will see you all next time.